I think that global growth projections are coming down, and silver has more industrial properties than gold does. So you'll tend to find that silver will lag gold when global growth expectations are receding. However, the discount to gold is very wide, and actually, my last personal trade was to buy silver coins and
Mm.
silver bars. So I mean, I like both. But silver's trading at a very steep discount. But it's lagged behind because it has more cyclical properties at a time when global growth is cooling off.
David Rosenberg, a Canadian economist and founder of Rosenberg Research, is known for his contrarian views and detailed economic forecasts. As global growth slows, Rosenberg observes that silver, which has significant industrial applications, tends to lag gold. The discount on gold is vast, prompting him to invest in silver. Although he favors both metals, Rosenberg highlights silver's potential while acknowledging its greater volatility than gold. Silver prices generally exhibit higher volatility due to their sensitivity to industrial demand, while gold is considered a more stable safe haven asset. Over the past week, silver prices have surged by 6.5%, outpacing gold's 1.6% gain. Despite this rise, silver remains 9.6% below its peak from May 2024, making a substantial push to multi-year highs unlikely. Year to date, silver has returned 25%, slightly ahead of gold's 22%, which lessens the expectation for any significant catch-up gains. Rosenberg notes that declining interest rates and a weakening US dollar drive gold prices. While he has long predicted that gold could reach $3,000 per ounce, he emphasizes focusing on underlying economic factors rather than specific price targets. Gold prices continue their record-breaking rally, staying above the crucial $2,500 level. This increase is fueled by a weakening US dollar and rising investor confidence that the Federal Reserve will likely cut interest rates in September. Spot gold rises 0.3% to $2,510.35 per ounce, hitting an all-time high of $2,531.60 earlier. U.S. gold futures also climbed 0.4% to settle at $2,550.60. Analysts predict that gold may continue to rise, with some forecasting a potential increase to $3,000 per ounce by next year. Before watching this video, please subscribe to our channel, hit the bell icon for notifications, and share it with anyone who might benefit from the content.
I think what's very interesting is that normally people would say, well, gold's a hedge against inflation, and inflation has come down and gold's gone up to record highs. The CRB index and a lot of these industrial commodities have come way down, and gold hasn't followed suit. And that's because the complexion of gold has really undergone a fundamental reorientation, where it is no longer viewed really as a commodity. It's viewed as a currency, and a currency that has no government's liability. So I think that investors are looking at this massive run-up in global debts and fiscal instability. I think to some extent, you've also had central banks, especially the BRICS, increasingly diversify outside of the dollar towards bullion. And a lot of that came out of the White House decision to freeze the Russian dollar reserve assets. So you have a lot of other, so call them rogue states if you want, that are thinking, well, we got to diversify our dollar reserves. What was really impressive with gold is that in the past 12 months, it managed to hit or approach all-time highs against every currency in the world, not just the US dollar. And that's telling you that investors are looking at gold more as a currency than a commodity, and importantly, a currency whose supply curve is very stable, does not represent any government's liability as currencies or what you call fiat currencies do. So I think there's the stable characteristics of gold. And on top of that, what are the principal drivers of gold? Well, two things. Interest rates, since the opportunity cost of holding gold is the coupon. And interest rates are coming down. So check, that's bullish. And since it's priced in US dollars, well, the US dollar has entered into a major corrective phase, which is going to continue because the Fed nobody went as far as the Fed did on the rate hiking cycle, and other central banks, many of them have already cut interest rates, not just once but several times, and so the Fed has a long way to go to play catch down to these other central banks. So weaker dollar, lower rates, all these other structural factors that I'm talking about has led to this bull market in gold. Now, people say to me, where do you think gold is going? And I've been saying for actually years, we're going to go to $3,000. We're approaching that level pretty fast. And then I don't know what to do once we get there. And I say once, I'm not saying if. And it's not a matter of hitting a price objective and then cutting bait. It's really going to come down to, are the factors that are underpinning the bull market in gold, are they subsiding or are they still in place? And if they're still in place, you'll have to still be bullish on gold. It's very difficult to establish a price for gold, a price objective. It's not like the stock market, the S&P 500. Is it really that difficult to have a price objective for the S&P 500? You need earnings and you need the multiple. Or is it difficult to have a forecast on the 10-year Treasury note yield? What's the real rate? What are inflation expectations? What's the term premium? Or you want to do interest rates or spreads in the corporate sector? Well, what is inflation going to do, and what are default rates going to do, and recovery rates? The stock market, like I said before, earnings, multiple, price to book, price to sales, price to EBITDA, do a dividend discount model. But gold doesn't provide you a cash flow stream. So it's really comes down to less of a price objective and more is the direction. Does it still have a tailwind or not? And I believe that the factors at play still provide it with a tailwind. And when those factors are no longer at play, I'll write about how the bull market in gold is done. Now, whether that's a 2,800, 3,000 an ounce, 4 or 5,000, that I don't know. I just know that the supporting factors at play are still in play.
DavidRosenberg observes that the federal funds rate, currently at 5.38%, is significantly higher than the 1.75% rate in 2019, indicating the potential for substantial cuts. He believes the Fed may reduce rates closer to 1.75%, surpassing the market's current expectations of 100 basis points in cuts and a terminal rate of 3.25%. Federal Reserve Chair Jerome Powell has signaled that it is time to start lowering interest rates, presenting a more dovish stance than many anticipated from the Fed's annual conference in Jackson Hole, Wyoming. The rate-cutting process is expected to begin next month, with a 25 basis point reduction likely at the Fed's monetary policy meeting on September 17th and 18th. Rosenberg's highest conviction call is that investors could achieve equity-like returns in the Treasury market over the next year without taking on equity risk. This expectation hinges on a normalizing yield curve and declining yield. Let's get back to the interview.
I would say most importantly, and very recently, we've had, Jay Powell invoke 2019. He did it in the Q&A on July 31st at the podium at the post-meeting press conference. And then in his text at Jackson Hole, he invoked 2019 not once but twice. And when I say invoke 2019, he deliberately said that the labor market, he mentioned the labor market 11 times. So the bottom line is that we can talk about sticky inflation and inflation. The Fed has moved on to the labor market, where the slack is expanding rather significantly. And there's something in the labor market. Remember, the Fed has more information than we do. Not that they don't make mistakes, but Jay Powell has a lot of information. And something's happening in the labor market that bothers him in a different way than it did 2 years ago when it was super tight. Now he's concerned that it's getting too loose. And he came out and said that. But when he says that, the labor market has more slack now than it did in 2019. And in fact, after the last FOMC meeting, he said things have normalized to where they were in 2019. Well, what I would want to stress to the viewers is that everything has normalized to 2019, except for the funds rate. And the funds rate right now is 5 3/8. And he invokes 2019 when the funds rate was 1 3/4 at the end of that year before COVID. I think the biggest mismatch, and that's what I try and do, I try and identify what the market is not seeing. And everybody's asking me the same question because the swaps market has 100 basis points of Fed rate cuts between now and the end of this year. And that might be too aggressive. However, the same market believes the Fed will take the funds rate this cycle to 3.25%, and that will be the terminal rate. And that's where I see the anomaly. Because I think that they're going back to 2019. I'm not saying we're going back to the zero bound, but if things have normalized to 2019, ipso facto, the policy rate's going to where it was in 2019. So as Pavel said, the pace and the path will be determined by how the balance of risks evolve and the labor market. So I don't know, 25 or 50 at September 18th, who knows? That's a flip of a coin. But where I have strongest conviction is the destination. And the market's priced for 3.25, but I have a strong suspicion they're going to 1.75.
Interesting.
And that's going to be huge for the call on treasuries.
That's a big
Because it
spread.
tells me when you do the yield curve dynamics, where will we be at the low on the funds rate on the 10-year note? 2.75. Where will we be in the long bond? 3.5. And that includes the work we've done establishing a fiscal premium. You're going to be able to make, between now and the end of next year, equity-like returns in the treasury market without having to take on equity risk. So I like the bond market a lot. That is my highest conviction call. The yield curve will pivot to its more normal shape. The whole curve will come down. The biggest yield decline will be at the front end of the curve, but the greatest return potential will be at the long end of the curve. And that is my highest conviction call for the coming year.
Gold prices continue to rise, driven by a weakening dollar and easing monetary policy. Silver remains undervalued despite its cyclical characteristics. Investors must navigate these shifts carefully to seize emerging opportunities and manage potential portfolio risks. The Federal Reserve is set to implement significant interest rate cuts starting next month, potentially lowering the benchmark rate from its current high levels to approximately 3.25% to 3.5% by mid-2025. What are your thoughts on how the Fed's upcoming decisions will affect gold and silver prices? Share your insights in the comments below. If you find this video insightful, subscribe, and hit the bell icon for the latest financial trends and investment strategy updates. Thank you for watching and stay tuned for more content.